some kind of metaphorical representation. This is a toilet in the Netherlands, by the way, where, I don't know if you guys can see it, but there's a fly here, okay? And it's actually not a real fly. It's a fly that's been painted into the toilet so as to give people some aim, right? Some target. And it turns out not only is the peeing experience a little more pleasant or enjoyable, right, because it's like you're playing a game, but from the part of the perspective of the janitors, it is actually very helpful too, because the spillage, it turns out, is a little bit less, depending on where you position the fly. Okay? So I think it's just a beautiful way in which you can direct people's behaviors. And I think that if you can give people some metaphorical representations of what mutual funds are, and here, I couldn't really think very creatively of what it could be, but maybe stock bundles or whatever, something that they're familiar with already, and connect it up to that so that the mutual funds are not seen as being that unfamiliar, and you give them direction on what to do next. Okay, so that brings me to the last issue of complexity, which is another big obstacle for the customer inertia. And I want to very quickly run through two examples of how complexity can impede people's decision-making ability. One is in the context of jams. There was a study done by Sheena Iyengar where she put in a grocery store 2 displays at different points in time. But one display carried only 6 types of jams, 6 flavors of jams. Another display carried 24 different flavors of jams. When there were 24 different flavors, more customers approached the table and they were interested in the jams, etc. And so that was good, so it would seem like having more choices is a good thing. But what happened is that if you looked at the number of people who actually bought the jams, right, it turned out that more people bought the jams when there were only 6 on display. Why? Because when you have too many options, what happens is that people get confused, and they think to themselves that there are so many options, I need to work through all of them to figure out which is the best option, because there's a reluctance to choose something that's not the best, And so they end up not choosing anything at all. If there's only 6, then they think that, 3 of them I can readily rule out because these flavors I don't like. Well, between strawberry and orange, I already have some little bit of strawberry left at home. Let me go with the orange, right? But if there's 24, then you're kind of lost. You don't know which one to choose. So if you can reduce the complexity, you can actually sometimes increase the sales. So that's the big message that comes from it. I'll actually skip the next example because of lack of time. But this is a slide that I think Monica had there as well. This also has to do, to some extent, with the how you can get around this problem that something is very complex by making something a default option. I'm sure that you already absorbed what the slide is from what Monica presented, but very quickly, basically, when you tell people that you have to opt out of donating organs after you die, in other words, you have to check a box saying that I do not want to donate. Only then do you actually get not to donate. That is that all your organs are intact when you're cremated or buried. It turns out that only 2% of the people, or less than that, actually bother to check the box. But if people have to actively check the box and decide to donate, then it turns out that on average only about 15, 17% want to donate. So you can actually get a lot of people to obey you by making something the default option or not. So this is one way to get rid of the complexity, because it's a very complex decision, to donate or not. If I donate, then, will I look ugly? Will, body parts be missing? And what will my relatives think of me? But on the other hand, if I don't donate, am I a bad person, because I'm dead? What is stopping me from donating? It's a very complex decision. You take the complexity out of the people's hands by making it an opt-in or an opt-out. It's called a default option. And so this has been done in a bunch of investment contexts as well, where people's retirement funds, they have to either opt in to retire, to add funds, or they have to opt out of it. And if they have to opt out of it, it turns out savings just automatically go up, right? So I don't know if you guys have an opportunity to go to some of the companies and tell them that, look, the employees who end up saving in your company actually turn out to be very satisfied with the company, and they stay with the company for longer. So why don't we cooperate, you and I, and we make your employees part of the salary, let's say 6%, go towards saving automatically. As soon as the paycheck comes, they don't even see this amount. It just goes into their savings in mutual funds. And perhaps the company also can donate, or contribute to some extent. In my case, University of Texas contributes about 6% to every 6% that I contribute. So if you do something like that, it might also increase the number of people who invest in mutual funds. Okay. The last way in which I want to talk about of overcoming complexity is to present what are called case rates or case stories rather than base rates or base stories. Basically what it is that when it comes to functional products, particularly financial instruments, there's a temptation to kind of, give people figures and, probabilities and so on and so forth. But most of us, as we saw from the very first slide, most of us are very emotional and we react much more to stories rather than we do to facts. Okay, everybody, and maybe this is not the case with you guys in this room. You guys are all financial wizards, so you might be different, but most customers are like that. And so, for example, there's been studies which have asked people or put people in two conditions. One of these conditions is this, which is a drier base rate version of the story. There's a decimation of eucalyptus forests in Australia, and the pandas being, the koala bears actually in this case, sorry, that's a typo, are being endangered. Specifically, about 20% of all koala bears are endangered. How much money would you donate? And people, yeah, they donate, okay, $50, $60. But then, if you give people this, which is a case rate, which is one particular koala bear, right? And they even give it a name so that they can relate to it. Let's call it Trippy. Trippy, a 2-year-old koala bear, lost his home due to deforestation. How much money will you give to help him build a new home? Turns out that people donate 5 times as much, right? Which is why when you receive all these public service brochures, mail-ins and all that, you might see pictures of particular children, right? This is the child that's going to be helped if you donate money. That is much more appealing to us, even if, in the end, the cause to which you're donating is actually a less important cause than to another cause for which you've only been given statistical information, right? So statistics is dry. So somehow, if you can take these mutual funds that you have, these beautiful, options that you have, that are actually much better than lots of other options that exist out there, and create a story around it. What is it that people can do? Oops, is it, yeah. So, maybe call a mutual fund the child education. Maybe you already have it, but I'm just saying that, so coming up with stories on what it is that this particular investment is going to achieve in the end in terms of goals that people can connect with. And in the advertisements and everything, keep kind of, hitting the same point that, this is what the mutual fund is going to do for you, either to do with child's education or to do with retirement or to do with marriages, etc., might be the way to go. Okay. So I just want to summarize by saying that there are 3 big obstacles that I was told, and I wanted to give you some insights into some psychological principles that have been, found to be pretty effective across a variety of domains that you could use and tailor it to your particular domain. All right, with that I'll stop. Thank you very much.
Thank you, Raj. It was a very, very interesting session. I'm sure you all found it very interesting. Was it interesting? Yes. Good to know. All right. We'll be quickly moving on to our next segment, which is yet another panel discussion, the topic of which would be to explore the emerging trends and opportunities in distribution. We have lined up the best and most articulate people representing the entire diversity in Indian distribution landscape. I'm happy to invite on stage the moderator, Prem Khatri, founder and CEO of Cafe Mutual, and the eminent panelists, Ashish Mehrotra, MD and Country Head, Retail Banking, Wealth Management and Retail Commercial Bank of Citibank, Hemant Rastogi, CEO, West Invest Advisors, Jignesh Desai, Joint MD, NJ India, Rajiv Bajaj, Vice Chairman and MD, Bajaj Capital, and Karthik Jhaveri, Director, Transcend. Ladies and gentlemen, I give you your panelists.
Friends, for the changing distribution landscape, we have gathered a panel which represents the entire diversity in the Indian distribution space. So we have people who operate individually, and then we have people who have big banks, and we have national distributors. So I think we should have good insights at the end of the session. We have actually a lot of ground to cover, but what we will do is essentially focus on 4 topics. So the first one, and I think in many ways the most urgent of them all, is how do you think the new regulations on registered investment advisors affected the distribution community as a whole? So I would like all of you to kind of represent the views of your category. So as an ND, you represent your views. As an independent advisor, you represent your views. So I'll start with you, Karthik.
Thanks, Prem, and good afternoon, everyone. You know, my views in RIA have always been a little more sort of out of sync with what's really going on. Every new regulation that comes in is obviously very, very, welcome. We all want to follow it. We all want to be a part of it. But
Voice.
what seems to be on? Yes. The volume people will have to do it. Hello. Is that better? Yes, I can hear myself. All right. So I've had a very different view on the RIA regulations ever since they've come in. And I've spoken this on various forums. See, the thing is, we have so many anomalies in our own system at the moment, and the regulation itself has a number of conflicts within themselves, and which is why it is very, very difficult from an IFA perspective or from a perspective of a boutique wealth management company like myself to go into that. See, on the one side, everything and everybody, all of us are already investment advisors by the virtue of the definition of investment advisor. But then immediately, as we move along the regulations, all of us are already out of it. Because obviously there's nobody left who's a pure advisor and who's earning nothing out of the non-advisory income, which is essentially commissions. Then what has happened, we've seen the last 150 or 200 odd registrations that have happened. So someone's getting this money on the father's name, mother's name, husband, wife, brother, sister. Someone's setting up a separate company to do that. But come on, there is a conflict of interest in everything, because the fundamental thing that the regulation's trying to do is to eliminate this conflict of interest and have a separate distribution and a separate advisory sort of entity. Now, that's obviously not happening. In fact, I think going forward, this might even cause inheritance and succession issues, because while the going is good in your family, everything's nice, but if the going suddenly went a little bit out of swing, you know what I'm talking about. Whether it's your spouse or whether it's your parents, if there's, because then you're connected with lines of succession there. So that also is a different dynamic which is going to play out. And which is why in the form that it is, I think it's really difficult. Going forward, do you think that RI would actually become established? Well, maybe, maybe not, because if it was something which was so fabulous and fantastic, I think a lot of us would have gone ahead and enrolled into it. But right now, there is no way to really prove SIDD. I mean, right from a very big institution to a very small institution, extremely hard to try and separate out these two business entities and then try and say that we are doing business on an independent basis. It has to be completely different. If I'm advising, maybe I should have an ICICI bank or maybe somebody completely non-related who will then do the execution. But that's obviously not profitable, isn't it? And see, the world over, we've seen this system where over a period of time, advisory business translates into a percentage or a profit share of the AUM, and which is obviously the deeper profit or the larger profit. So if you're going to have a small quantum of money which you're going to charge, then in 2-3 years, you'll learn very quickly that this is not going to work out. So I think right now, the people who are enrolling, it seems some sort of a thing to do. The way CFP was a thing to do, maybe about 8 or 10 years ago, and everybody wanted to enroll into it. So today, we're trying to do something again by which we can differentiate, go to our clients and say, you know what, now I'm an RI. Maybe SEBI's done this thing, so therefore I'm in a slightly better position than the rest of the market. So it's a differentiation thing deep down, rather than having a very, very profound impact on the way we do our business. Because I think for all the people who've even done this thing, there is no change in business, there is no change in income, except that the income sources and the income destinations have changed. So to that extent, I think there is still a little bit of time. We need some more uniformity. We need some more, standard or a uniform level playing sort of a field, if you like. So just the way it happened in 2009, suddenly all the upfront commissions went away. Something like that, if it happens again, then obviously the market dynamics would change. So all the people who today do free business will have to be under the force of doing a paid business. And that's the time RI will really shine in its true glory.
Okay. Hemant, what are your views on this? And have you, first of all, applied for registration?
Yes, Prem, we did, and we got our registration.
Okay.
I'm quite okay with the registration per se, because at the end of the day, you're dealing with somebody's money, so I think some amount of regulation, trying to ensure that money is taken care of, is fine. Because let's not also forget that what